Warren Buffett famously said,
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing.
This is a stark contrast to what is taught at virtually every business school. By constructing portfolios consisting of an increasing number of issues with varying correlations, we can effectively eliminate diversifiable firm-specific risk. Some refer to this with the folksy adage of investing in ice cream and umbrellas. On nice days, people buy ice cream. On rainy days, they buy umbrellas. If you own stock in both companies, you've likely reduced the risk due to weather. But this security comes at a cost. Diversification, like any hedge, will almost certainly protect against downside risk by trading away some upside potential. As Buffett points out, diversification may simply be a protection against ignorance. The astute manager might pay attention to the number of sunny days compared to rainy days and balance the portfolio accordingly. They might want to adjust the portfolio mix seasonally. It's likely that less ice cream is sold in the winter, but it may also be likely that fewer umbrellas are sold in the winter. These seasonal cyclical trends may well already be present in the market prices. Buffett would expect his managers to know that there is a coming surge in Sesamina inferens populations, an insect infestation that will cause sugar production to drop by as much as 50%. This will drive up the cost of sugar, increase the cost of ice cream, and reduce profits accordingly. An astute fund manager may sell the ice cream shares, short some additional ice cream shares to earn profit as the stocks inevitably fall, then repurchase at a lower price before the next season. Most investors are unlikely to delve into this level of detail. Similarly, I doubt that owners of Berkshire Hathaway stock are paying that level of attention to the 47 publicly traded firms in which Berkshire has a sizable interest, or the 71 private companies that they own outright. Indeed, despite Mr. Buffett's dislike for diversification, Berkshire has interests in bricks, insurance, underwear, jewelry, paint, financial services, real estate brokerages, clothing, energy, banking, furniture, food, beverage, construction, consumer goods, aerospace, business jet leasing, sports equipment, consumer electronics, shipping, pharmaceuticals, communications, entertainment, and believe it or not, investment companies. More generally, Berkshire has holdings in insurance, shipping, energy, consumer goods, and banking. Would an investor who does not have intimate knowledge of each of these businesses be ignorant? Perhaps. But the owner of shares of Berkshire Hathaway certainly does not bear substantial specific risk. Another famous quote from Mr. Buffett is rule number 11. Oh, wait. Do you understand how the product works? Interestingly, Berkshire does not have substantial interest in medical services, semiconductors, alternative energy, including nuclear, electric vehicles, or defense. All are growth industries with many expert leaders available to guide competitive companies. So, is Berkshire diversified? Well, at the corporate level, I would have to say yes. An investor who owns Berkshire does indeed enjoy a portfolio with diverse correlations and unrelated business cycles. Each of its companies is optimized to operate at the highest levels within their respective business segments. Each is managed by experts in their fields, and I'm certain that they know which insects might influence production costs. The chart shows that over the past 15 years, Berkshire outperformed both the Dow and the S&P 500, but fell short of the tech-heavy NASDAQ. Berkshire famously avoids tech stocks because of their volatility. Each of these plots can be described as a random walk with a positive skew. It's intuitive that they are all subject to the same systemic risk. In 2009, all were equally squelched by the mortgage-backed securities financial crisis. Moving forward, in 2011, they were all subject to Black Monday when Standard & Poor's reduced the credit rating of the United States government. In 2016, Brexit, the surprise election of Donald Trump, and a record dip in oil prices caused systemic flattening. That was followed by a rapid rebound. Between 2020 and 2023, COVID-19 shocked worldwide markets uniformly, causing proportional declines in virtually all issues. This was followed by a systemic recovery, resulting in record highs. What is the magic that diversification performs that causes these dissimilar portfolios to move in relative unison? There is math behind it, and it turns out that reducing risk does not affect expected returns, and I'll prove it. When we construct a portfolio P consisting of N assets, the expected return of the portfolio can be calculated as the sum of the weighted average of the returns of all of the individual assets in the portfolio. The risk is measured as the variance or volatility associated with each asset. This is the square of the standard deviation. Volatility has two components. The asset is exposed to systemic risk, which is measured through the commonly available published parameter beta for each asset. This captures its sensitivity to the market average. This risk will always be present and cannot be reduced through diversification, so we can ignore it for this discussion. The other is the variance that is unique to each asset and is called idiosyncratic risk. This risk is given by the following formula. The variance of the portfolio is equal to the sum over the sum of the weights of each variance plus 2 times the weighted covariance between the two issues, where E sub I and E sub j are the expected returns of assets I and j as part of the portfolio. The math required to calculate the impact of the various weights of each portfolio component becomes quite complicated as the number of stocks increases. It can be easily solved with computer software or with a spreadsheet. For simplification, we can assume that each weighting is equal and that each asset makes up 1/nth of the overall portfolio. So we can replace W with 1 over n squared, or W with 1 over n, which W squared then becomes 1 over n squared. And the formula for standard deviation or for variance becomes sigma squared, sum 1 over n squared times the first plus 1 over n squared times the second plus 2 times 1 over n squared times the covariance between the two. Further simplifying that formula, we see that sigma squared for the portfolio, the variance of the portfolio, is you can bring out the 1 over n squared from the sums. Now we can see that idiosyncratic or firm-specific risk is reduced with the square of n. In fact, for a portfolio containing only 10 assets, diversifiable risk is reduced by 99% because 1 over 10 squared is equal to 0.01. When risk is multiplied by 0.01, it effectively is reduced by 99%. Note that the expected return of the portfolio is not affected as the number of stocks increases. Now recall the 4 example portfolios in the graph above. Berkshire Hathaway, the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. It becomes apparent that all have similar exposure to systemic risk, and none of them appear to be affected by idiosyncratic risk. I wonder if Berkshire will take another look at some of the tech stocks traded on the NASDAQ. By bearing the improved risk-adjusted returns associated with the technology assets, better overall returns over a long period of time have certainly been demonstrated. One final thought on diversification. We showed mathematically that the expected return of each stock in a diversified portfolio is not reduced through diversification. The potential return of the entire portfolio is reduced through diversification. If an investor were able to limit their investments to only issues that would go on to deliver the greatest returns, they clearly would have done better. For a passive investor, diversification seems as if it may be the preferred strategy. If the investor is an activist, though, they will exert some influence on the management and operation of the companies in which they invest. This is especially true for venture capitalists making investments in new companies. It's likely that the founders of startup companies would benefit not only from the financial contributions that a venture capitalist can provide, but also from their guidance and experience as seasoned entrepreneurs. This increase in the probability for success is of the highest importance to investors with longer horizons who require returns that historically exceed those available in the public markets. Banks, universities, family offices, insurance companies, retirement funds, and corporate investors require these alternative investments to achieve the returns necessary to accomplish their missions and at the same time exceed inflation and perpetuate the core fund. Polynomial Ventures offers wealth management with access to alternative investments for accredited investors. Check us out at polynomial-vc.com.